Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil markets. Paris Rapeseed. There are at this time two key patterns here. The first and larger one is the February 2021 to July 22 ascending broadening wedge pattern, currently 797 to well up off the top of my daily chart, far enough that it becomes immaterial. To be honest, you can't really see it as it's so large, but the lower trend line for this is highlighted in the upper part of my daily chart in dark blue. This was not a perfect pattern, but it had been the main market driver higher in the earlier part of 2022. The break lower in July last year left the following incredible targets on the downside. The primary target X is in the 352 even area, for harder to reach target, secondary target X1 in the 217 even area. These are obviously pretty much way out there targets that you can put into the back of your diary on the back page and just look at maybe once a year. A newer, smaller pattern, though is still quite big on this daily chart, is the early July to late October last year bearish Andrews pitchfork. The market is at the moment in between the middle time below, currently at 498, and the upper time above, currently 569. You can see the lines highlighted in purple on my daily chart. I thought when I drew this one that it might eventually need finessing or even turning into a shallower bearish shift pitchfork, both of which I'd be happy to do in a heartbeat. But so far, well, it has not needed any surgery, and it's still excellent in showing the bearish angle attack of the market, all the way since late October last year. Finally, there is again the elephant in the room to address, which may be becoming the beginning of a herd of elephants. You see, we had a monthly key reversal down in November last year, and whatever you do, please make sure you take that into your calculations or thoughts. Now, there had been a weekly key reversal up in mid-December, and we have seen a follow-through higher to that for the following 2 weeks thereafter, but prices ran out of steam on their approach to the upper time back in early January, and the market turned lower, such that January, the first month of 2023, made another monthly key reversal down. Thus, we come to the last 2 and a bit weeks of action, and the apparent stalling of the decline pull back up with a flat top and higher low, something that is usually seen as a bullish build-up, where, for now at least, I think this behavior can be explained by two reasons, both reasonable. The first one, and the one I suspect is the stronger one, is that the easily labeled congestion from all the way back in September 2012 between 513 and 3/4 and 519 and a half, that's acting on the market. The second one was the market approach to the more recent middle time towards the end of January of the previously mentioned bearish Andrews pitchfork in purple. This middle time is now below the congestion, and it'll be interesting to see if the overhead Fibonacci congestion of 548 to 551 will, along with the rapidly descending upper time and the paralleling and declining short medium moving average, currently 566, whether they will turn prices back down again towards that September 2012 congestion zone. Winnipeg Canola. If I take you back to late summer last year, and I had said the following, and I quote, "It became evident since the start of the sideways to lower movement was seen here since June, there was a shallow bear channel." That's currently actually between 879 and 763.5. And I carried on. "And is this that had been driving the market lower during the summer?" End of quote. To emphasize this point, I further added, and I quote, "So it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market." End of quote. Well, as you can see, that bear channel is still there, and it is still leading the way lower. In that time, it had been breached on both sides, most recently in early November, but it still remains valid and is highlighted in dark blue on my daily chart. Now, we had another feature that has impinged upon the market. It is the June 2020 to date uptrend, currently at 820.80, which is highlighted in bright red on my daily chart. The market came close to testing this back in early September and then again in late November, and it finally punched down through the uptrend 2 weeks ago. And for a few days, it looked like we could see this bear channel morphing into a sideways triangle, with all the implications that may have. This idea of changing into a sideways triangle, for the moment, looks now dead. However, I'd leave the potential targets below for this loosely constructed potential sideways triangle of a primary target X in the 768.5 area and a secondary harder to reach target X1 in the 688 even area. I'd leave them alone just in case prices turn back down again. After all, we are not too far away from shifting back lower. Now, one final point, and it's something I've raised some 6 weeks ago and every time since, and I quote, "There is just the thought of what may be the whole April to date action. It could be seen as a bottoming action. You see, it can also be seen just as it is, a shallow bear channel, or you might look at it as part of a very large bearish halfway hesitation. It is all still too early on these thoughts, but I think they need to be present when things start to happen, eventually." End of quote, which is why I've kept that quote in there. I would add one final item. We had a not very good dead cross of the declining short medium moving average, currently 839.60, and what is now rising but earlier a very shallowly declining medium moving average, currently 850.20. As I said, it's not a very good dead cross on what is a lagging indicator anyway. Most of Malaysia, crude palm oil. Over September and mid-October, the market formed a small but effective reverse head and shoulders pattern. It was the break higher over the neckline, highlighted in dark blue on my daily chart, combined with the break higher over the old neckline of the September 2015 to November 2017 head and shoulders top, currently at 39.24, which is highlighted in bright red, and finally the break above the short medium moving average, currently at 39.45, that altogether caused the move up in early November. It gave potential targets in the upside of a primary target in the 42.45 area and a secondary harder to reach target X1 in the 44.40 area. In late October, prices reached the primary target and we've come close to target X1 as recently as early January, but we've not managed to get there so far. I thought about retiring the target X1 more than once, but I'm cautious as I am. I've kept it on and I will again for a little while longer. See, every time we've seen an attempt higher, we've also seen the market drop back to the seeming security of the combined support of the old neckline, the short medium moving average and the medium moving average. That one's currently at 39.04. I have more to say on these moving averages shortly, as I wish to expand on a new pattern I discussed some 6 weeks ago. In the meantime, I had also drawn a mid-August to early November 2022 mildly bearish shift picture, which is highlighted in green on my daily chart. The market is currently in between the middle tie and below, currently at 36.61, and the upper tie and above, currently 42.98. Now we've seen prices gently heading lower between these two ties since the pitchfork was created back in November last year. This pattern seemed, and still seems, to be doing the running of this market lower at this time. Now, before we stop looking at anything else and concentrate on this pitchfork, there is something I would like to discuss. We had a number of gaps recently, and I would draw your attention to the last 2 days of last week that left an imperfect island below this week's market. And with the action of this week also as a throwback higher. However, the market has gotten bogged down in the throwback at the congestion of the moving averages, the neckline and the February 2011 high in between about altogether between 38.63 and 39.86. So to round it all up, nothing much has changed. We are where we were, but I know for sure this cannot continue indefinitely.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.